When a company decides to go public, it is often seen as a significant milestone in its growth journey. This process, known as an initial public offering or IPO, allows a private company to offer its shares to the public for the first time. But why would a company choose to take this leap into the stock market? First and foremost, one of the primary reasons companies pursue an IPO is to raise capital. By selling shares to the public, a company can generate substantial funds that it can use for various purposes. This could include expanding operations, investing in research and development, or even paying off existing debts. For instance, when tech companies like Uber and Airbnb went public, they raised billions of dollars, enabling them to scale their operations and enhance their services. Moreover, going public can significantly enhance a company's visibility and credibility. An IPO often brings increased media attention and public interest, which can lead to greater brand recognition. This heightened visibility can attract new customers and partners, further driving growth. For example, after its IPO, the electric vehicle manufacturer Tesla gained not only financial resources, but also a stronger market presence and consumer trust. Another compelling reason for a company to go public is the opportunity to provide liquidity for its existing shareholders. Founders, early investors, and employees who hold stock options may wish to cash in on their investments. An IPO creates a market for the company's shares, allowing these stakeholders to sell their holdings and realize their gains. This is particularly important in the tech industry, where early investors often seek to exit an investment after years of growth. Additionally, an IPO can set a company on a path to further acquisitions. With public shares, a company can use its stock as currency to acquire other businesses. This can be a strategic move to bolster its market position or diversify its offerings. Facebook, for example, used its stock to acquire Instagram and WhatsApp, which significantly expanded its reach and capabilities in the social media space. However, while the benefits of going public are considerable, it is crucial to acknowledge the challenges that come with it. Public companies are subject to strict regulatory requirements, including regular financial reporting and audits. This can impose a burden on the company's management and require a higher level of transparency than when it was privately held. The scrutiny from analysts and investors can also increase pressure on company performance. Moreover, a public company must deal with market fluctuations that can impact its stock price. This volatility can lead to uncertainty and may affect the company's long-term strategies. For instance, if a company's stock price drops significantly due to market trends or poor quarterly results, it may lead to a loss of investor confidence, which can have lasting effects. In conclusion, the decision for a company to go public through an IPO is multifaceted. It often revolves around the need for capital, increased visibility, liquidity for existing shareholders, and the potential for strategic acquisitions. Yet, companies must carefully weigh these benefits against the challenges of public scrutiny and market volatility. Each company's journey to the stock market is unique, shaped by its goals, industry conditions, and market dynamics. Understanding these motivations and implications can provide crucial insights into the ongoing evolution of the business landscape.